Hey guys, in today's video I'm going to tell you the top 5 things your financial planner doesn't want you to know. And if you stick with me to the end of this video, you'll know so much more about your retirement situation and you'll be able to make an educated decision on whether or not you should work with a certain financial advisor you're considering or if you should stick with the one you currently have. The first thing your financial advisor doesn't want you to know is what fees you're actually paying. Maybe you had the conversation originally, but more often than not, it probably was never brought up, or if it was, you don't even remember it anymore. So most advisors either work on a commission or on a fee basis, and they all charge a percentage of your assets. The majority of accounts that I see that people have with large establishments are the ones that work on commissions, and you're paying 5 to 6% in upfront fees alone, in addition to other hidden fees on the back end. These are especially common when you're using Roth IRAs. I see this nearly every day as someone brings in a statement. You're having this fee of 5 6% every time you put money into it. So you're putting $100 in a month, you're starting off with only $94 going into it. Or in other words, a negative 6% return. So if you've been funding an account for a while and wondering why it's not growing quite like you thought it would, this is probably why. A good chunk of that money is being taken as a commission and going towards that firm and that advisor. For the ones that charge fees, most times they quote you at a 1% or 1.5% fee. And it's kind of hard to put percentage to actual number amount. But just think of it. If you have $100,000, that's $1,000 per year. If you have $500,000, that's $5,000 a year. What they won't tell you is that it actually doesn't cost them any more money to manage 100,000 or 500,000. So really you're paying 5 times the amount of fees and they're not doing any more work. Now, that's something they'll never ever admit or tell you because that's just the way the industry has built itself. The second thing your financial advisor will never tell you is that using an annuity to replace your bonds can offer you a better performance overall. It may sound crazy, you probably heard annuities are expensive, and most advisors would never use them or even brought them up or use them in this manner. But the fact remains that if you were to replace the bonds you currently hold in your portfolio with an annuity, you probably have a better performing account. Why is that? Annuities have no market risk. Bonds do. In 2020, we had this giant crash. Bonds went negative. Annuities didn't. They still had that guaranteed rate of return. Now, this is something a lot of advisors don't tell you about because their fee relies on how much money you have in the market. And if you were to take money and put it into an annuity, they can't charge you the annual fee on it. So it's not going to be work towards their best interest, even though it may be doing better for you. The other thing this is going to do, it's going to dramatically reduce the risk you're taking. Remember that these annuities are guaranteed. They have no risk in them where the bonds do. So if you took 40% that you had in bonds and moved it into an annuity, you'd be reducing your risk by 40%. Even though bonds are considered low risk, they still lose money. Many of them still lose 5 or 6% when the market goes sour. Well, these annuities are guaranteed. They don't go negative. So it's a way to dramatically reduce the risk that you have in your portfolio overall. The third thing your financial advisor isn't going to be telling you is how important long-term care costs is. In fact, there's a 70% chance, 7-0, that you're going to be using some kind of long-term care in the future. In other words, in the next 20 to 30 years, there's a 70% chance your monthly expenses are going to increase $8,000 to $10,000 per month. That's huge and wipe pretty much anyone's retirement out. Now, a lot of planners won't tell you about it or work with you to find a plan. They'll tell you have enough money and it should be enough to last. But the fact is, it's probably not going to be the case. I mean, think about it. If all of a sudden you have to take $10,000 out per month and it's for a long-term care need that's going to last 2 to 3 years on average, there's probably not going to be much left of your account at all. The way I look at this is if someone were to call me to tell me that their spouse has been placed in some kind of long-term care facility, do I want to be the guy that says, I'm sorry to hear that. Which account do you want to start draining down first? Oh yeah, and on top of that, we have to account for taxes. We have to take out more, and your account's probably going to be drained in the next 2 to 3 years, and you have nothing left for the rest of your life. Or do I want to be the guy that says, sorry to hear that. Thank God we had that long-term care plan in place. Let's get the plan started right now, so you can at least offset some of the expensive, if not have it completely covered. That's just the way I think about it and the way it should be done. The fourth thing your financial advisor is probably never ever going to tell you is that you're going to pay way more in taxes over the long term than if you were to bite the bullet and pay them now. Now, why aren't they telling you this? Because taxes are complicated. No one wants to do Roth conversions, do all the paperwork, and learn about tax codes and look at your income, make sure we don't go over a certain threshold or increase your Medicare payment when you take out too much money. It's a lot of headaches. So most advisors just stay clear of it. They let your pre-tax account sit there, they do their reviews, and it just snowballs and snowballs and snowballs. and secretly you're going to owe more and more taxes over the long run. I mean, with taxes being as low as they are today, where the highest tax bracket is only 37%, that's a discount. If you look back over time, back in the 80s, the top bracket was 70%. Now, I know many of you guys aren't in the top brackets. Why does that matter? The fact is, the middle brackets will follow the top bracket. So back in the 80s, when the top bracket was at 70, the middle bracket was at 37%. So if taxes go up for the rich, typically the middle brackets will fall to a degree. And if you don't think taxes are going up in the future, you just have to kind of look around and see how much debt this nation's taking on, especially with the pandemic and all the stimulus packages coming out. The fact is, when you have too much debt, the interest payments start adding up, and over 10% of the US budget actually goes just to pay our interest today. And the only way the government can make up for that is to increase taxes. And any accounts you have that are pre-tax are really just sitting ducks for those taxes to happen. Now, whether they take them in your life or they take them when your kids inherit it, they're going to get their income one way or another. So it's important to do tax planning today to minimize the amount of taxes you and your family is going to pay over the long run, so you keep more of your hard-earned money. And that's something most advisors will never ever tell you or talk to you about, simply because they don't want to or they don't know any better. The fifth thing your financial advisor will never tell you is that they don't specialize in retirement income planning. Now, most people have the assumption that all financial advisors help people with their retirement and they all know what they're doing. The fact is that's not true. Most of them are taught how to get people to sign up and enroll and systematically invest money with them and build up for retirement. But the fact is, when it comes to taking money out of your account and actually spending and enjoying your money, most advisors have no clue what they're doing. They'll tell you to use some old financial rule, like the rule of 4%, that really doesn't work quite as well anymore, or they'll put you in some kind of crappy financial product that their sales manager told them to use, or it's one that their company makes and sells itself. Most advisors really don't know what they're doing when it comes to retirement income planning. It's kind of like when you look at Mount Everest, the majority of people don't die on the way to the summit, they die on the decline. If you don't have a Sherpa to guide you down, you're going to make some kind of fatal mistake, and it's the same thing with your retirement. Anyone can help you build money for your retirement, but when it comes time to start drawing it down and making sure you're not going to run out of money, you want to work with somebody that knows what they're doing and specializes in retirement income planning. So just because your advisor got you to retirement doesn't mean they can get you through your retirement. And one other thing you want to consider is how old your advisor is. Are they actually going to be there with you throughout your whole retirement? I mean, if your advisor is older than you or the same age as you, there's a good chance they're going to be retired and long gone when you need them during your retirement years. So it's important to consider when you want to work with somebody throughout your retirement that they're going to be there. Make sure you check out these other videos on the screen to learn these other financial secrets you may not know about. Make sure to subscribe to the channel as well if you want more content like this. And remember that your future depends on what you do today.